So you recently opened your 2026 renewal notice and bam, a massive premium spike. No claims filed, zero water leaks, absolutely no tenant complaints last year, yet your rates are through the roof? If you are sitting there scratching your head, trust me, you are not alone. It is literally the #1 insurance question out-of-state investors are asking right now. Welcome to this explainer, where we are going to break down exactly what is happening behind the scenes in Kansas City and how you can strategically respond.
Just a quick heads up before we get into the weeds, this explainer is strictly educational. It does not constitute legal or tax advice. Always consult with your own certified professionals regarding your specific portfolio. Here's our agenda for today. We will look at the spike and the causes, the percentage deductible trap, coverage cuts that backfire, and finally, age, roofs, and smart strategies.
Section 1, the spike and the causes. Missouri data matters. Let us start by unpacking the localized data driving this huge mismatch.
Take a look at this number right here, 173,000. In 2025, the Missouri Department of Commerce and Insurance logged a staggering 173,000 homeowners insurance claims. That is a massive volume of damage concentrated into just a single 12-month window.
To put that into perspective, those claims totaled roughly $1.6 billion. That makes it Missouri's largest storm loss total we have seen in several years, driven almost entirely by severe wind and hail.
Now, why does this matter to you? Well, Missouri insurance regulations actually require carriers to price their policies based on this specific in-state claims history. A bad storm year in Missouri hits everyone across the state, regardless of the carrier. This is totally different from neighboring Kansas or national averages. Furthermore, Missouri strictly prohibits insurers from using other states' losses to base their rates. So thinking you can just shop around to a different carrier? Unfortunately, that is not going to magically erase that $1.6 billion of Missouri storm data from your quote.
Then you have to layer on the cost of reinsurance. Think of this as insurance for the insurance carriers, helping them survive these catastrophic seasons. We recently saw a hard reset in the reinsurance market nationally. When those costs jump for the carriers, that expense rolls straight downhill to your rental home renewal. It hits your Kansas City or Blue Springs property just as fast as a beachfront house in Florida.
Section 2, the percentage deductible trap, a costly illusion. To combat these crazy premiums, you might be looking to make some structural policy changes. Carriers are actively pushing owners away from predictable flat dollar deductibles, like a standard $1,000 out of pocket, and steering them toward percentage-based deductibles. The catch is that a percentage deductible moves with the total property value, not the size of the actual claim.
Let us run the math on this. Take a median $289,000 Kansas City home. If you agree to a 2% deductible to lower your monthly premium, you are paying $5,780 out of pocket before the policy pays a single dime. But here is the real trap. The most common claim in this market is a moderate hail hit that costs a few $1,000s to fix. If your deductible is almost $6,000, it exceeds the whole repair cost. You end up footing the bill entirely while still paying a premium for coverage you literally cannot use. It is a complete financial illusion.
Section 3, coverage cuts that backfire. Hidden exposures.
Beyond deductibles, owners try to cut corners in ways that look great on a spreadsheet but fail miserably in real life. Take actual cash value coverage. Owners use it to lower premiums on older roofs, but it only pays the depreciated worth of that roof. When the repair invoice arrives at today's labor and material prices, you are left with a massive funding gap. And leaving a tenant-occupied property on a standard homeowner policy? That is a quick ticket to a denied claim the second the carrier finds out.
So, you might be asking, should I just drop loss of rent coverage entirely? I mean, it feels unnecessary right up until the moment disaster strikes.
Alpine Property Management, Kansas City, sees this exact cut backfire the hardest. Here's the reality check. A routine turnover between tenants takes about 14 days, but a storm rebuild, that can drag on for months. And guess what does not pause during those months? Your mortgage and your management fees. If you drop this coverage for a tiny premium reduction, you are suddenly forced to personally fund every single month of that gap out of pocket, with absolutely zero rent coming in.
Also, whatever you do, never trim your liability limits. It might look like the smallest line item on your page, but a tenant or guest injury claim does not shrink just because the rental is a modest home. Legal defense costs alone can completely drain a thin policy limit before a settlement is even discussed. If you hold more than a couple of doors, strongly consider layering an inexpensive personal umbrella policy on top of your base limits.
Section 4,
Age, roofs, and smart strategies. Protecting your investment.
The whole underwriting game has shifted. Carriers do not just take your application at face value anymore. They use high-tech aerial and satellite imagery to scrutinize your roof's condition. This is a huge deal for older cash flow properties in submarkets like Independence and Raytown. If you are an out-of-state investor buying there, you absolutely must price a roof replacement into your initial math before closing, rather than discovering it the hard way at your first harsh renewal.
This is exactly why Alpine Property Management Kansas City proactively flags outdated limits and roof issues at onboarding and every single renewal. Serving investors since 2013 and managing over 250 properties, they use their deep experience to keep things running smoothly. Their strict discipline around rapid leasing and routine upkeep maintains an impressive 96% occupancy rate. That matters deeply because vacant or under-maintained homes draw massive underwriting scrutiny and way steeper pricing.
Okay, here is your specific game plan before your next renewal. 1. Pull that declarations page early. Do not wait for the shock. 2. Confirm your dwelling coverage reflects current rebuild costs and insist on exact dollar deductibles, no percentages. 3. Make sure your loss of rent limits match current market rates, not what you charged 5 years ago. And 4. Run all these numbers through a property management cost calculator to evaluate your true ownership costs.
I want to leave you with this. A higher deductible can actually be a smart trade if you have deep cash reserves, but it is a terrible idea if you have not budgeted for it. Please, do not self-insure by accident. A single Midwest hail season will quickly wipe out years of perceived premium savings in an afternoon. The storm will make the financial decision for you if you are not prepared.
So let me ask you, are you truly protected, or are you just crossing your fingers and hoping the next storm skips your zip code? We hope this explainer has given you the clear, data-driven insights you need to navigate this tough landscape. For help managing your Kansas City rental property, call Alpine at 816-343-4520 or visit alpinekansascity.com.